Good afternoon, I hope you're doing well. In today's video, we'll continue with a series of using price action to analyze Nifty and hopefully to be able to take better decisions in the market. So we'll start today by analyzing the Nifty on the weekly chart because of what we are seeing. So what started off as, if you remember, if we actually go through our videos from a couple of weeks ago, you will note that we had discussed the possibility at the time of a potential flag pattern where when we were seeing this, so maybe I think I'll just darken this a bit here, and when we were seeing this on the upside. So something like this is how the image was looking. So you will see that during this time of the week, the assessment would have been that Nifty has formed a chart pattern, a flag pattern, and a bullish flag pattern obviously was giving Nifty a 30,000 point target. But a flag pattern has certain characteristics of behavior, and the simple characteristic is that once it has formed a pattern that looks in this manner, there is maybe a 30 or a 20% pullback from retracement. I would say from its high. 20% retracement would mean that, let's assume that this value is 100, this value is 110, then the pullback happens quite shallow, say till 108 to 106, and it takes off quite fast. That's the characteristic of a flag pattern. And what do I mean by characteristic of a flag pattern? So what typically happens is that patterns obviously get formed over a longer duration of times, and the reason why patterns form are because traders of specific behavioral mindsets are in the market. Traders with large capital, traders who are influential institutions, that is big money traders, have a certain kind of a view or a mindset related to a particular economy. Now if a stock which is structurally bullish all of a sudden begins to form a bullish flag pattern on the weekly chart, that looks like it is ready for a rapid move on one side, but then it should also move like that immediately, that follows. But what follows here does not look like a typical flag continuation. In fact, what follows here is that actually instead of getting a flag kind of a continuation, what we ended up getting here is a very small, for example, a saucer. So I'll just connect this point with this point and extend this lower and darken this a bit and thicken it for better visibility. And if I zoom in to this structure, so instead of getting a runaway market, what we actually ended up getting is a saucer pattern. Now a saucer pattern, the difference between a flag pattern and a saucer pattern is the same as the difference between T20 cricket and a test match. The objective is the same. The objective is to score high runs, to take opponents' wickets quickly, to effectively win the game. But the question is the mindset of the players getting into those two events. So the players who are getting into a T20 are getting into a sprinter's mindset, that they have these few hours in which they have to get the most they can. Whereas players who are getting into a test match of 5 days are getting into a marathon runner's mindset, where they believe we are going to get there, but we have to maintain a consistent pace for longer durations. And obviously these two approaches are different. Which one would we prefer? As short-term traders, obviously we would prefer high-speed markets, but what are the markets actually offering us is a sort of a saucer pattern. So this is the change that actually happened after the bullish flag assessment to it now being a bullish saucer assessment. And when we get a bullish saucer pattern, the structure effectively remains the same. It gives it, obviously here the targets are a little shorter to begin with. The target is obviously going to be just about 1500 points from this in the subsequent period. But having said that, the stop loss will also be much smaller than what we were getting earlier. Having said that, we should expect a tougher price movement going into the future. That is, it's not the time to just like throw in all the money. It is time to be long. It is time to be objectively bullish on the market, but we don't have to rush in, because it is in the very nature of a saucer pattern to time give deeper pullbacks into the market, which crushes through critical moving averages, and then the markets take support and resume the trend upwards when it seems very unlikely So keeping this broader theme in mind, we now move into a daily time frame, and in the daily time frame we will begin from where we stopped last week. And last week we discussed the possibility of a bearish counter attack candle, and obviously the formation of a continuation. At the time, obviously the continuation candle was not formed, I think, when the video was taken. And the estimate was that if there is a continuation, then obviously, if you remember in just the, I think this is maybe the previous video, the idea that I suggested was that we wait for a pullback. We wait for a pullback till approximately this level. I'll just mark it here. And the reason why I suggested that we wait for a pullback is because if we connect this, we had discussed this last week, but we'll just recap it. If we connect this low with this high, and the reason why we are connecting this low with this high is because, I'll just remove this line for now, is because if I zoom in a little bit, first I'll just mark this line here and I'll darken it. Maybe I'll just change the color to black. Now, if we zoom in, basically this value here is the value at which the market broke the previous range, which means the hypothesis is that the market could start trending because it broke the previous range. And we are using Fibonacci retracements in order to establish how strong that particular trend is. We know that Fibonacci retracements above 38% are very strong, which means Nifty correcting just 200 points will still keep a strong uptrend in play. And a pullback above 68%, around 68 to 78%, means that the market is extremely weak. So it is possible that the market could come all the way till here, but still retain an upward or a longish bias. Obviously, there will be different strategies to trade a strong pullback and a weak pullback. It is my view that that regardless, we have to see for it to test at least some zone. And after the formation of this bearish counter attack with its confirmation, we can see that the previous high actually has held up as a resistance. And now if I just simply extend this to this value here, that is the low of the confirmation, this will look like a range on the hourly chart, more specifically like something like a pattern on the hourly chart. So I'll just mark the lines here. So you can just see, so say for example, I extend this all the way till here, followed by this one here. It's a steepish point, followed by this here, and this one right here. So at the moment, it's looking like a double bottom, but obviously if it extends, it'll become like an M pattern. And that's obviously a bearish pattern in a bullish structure. So we have to keep that in mind, which means that one could obviously plan to buy, which is what I suggested when I had suggested in the previous video, is that one waits for a pullback till approximately this level. By suggesting means I do not mean that you should do it, but what I mean is that when the market is on its way downward, I am going to assume that the market will hold the low and it will continue with a move in the direction of the preceding range break. This is how I am building up my positions. Okay, and I'm expecting deeper pulls, or I'm planning for deeper pulls. That means if I want to buy, if I say for example something here, market is at 25,000, which means every 1% is 250 points. So this is like obviously a double bottom at the moment, but 1% below it is one support, another percent below it is another support. That's this gap support that we can see. So what will actually happen is that I will plan for buying up to 2 to 3% of market correction from here. So it doesn't mean that I'll just simply go tomorrow and buy the market like outright, but rather, let's say if there is a stock like ITC. So if the market corrects 250 points, maybe stocks like ITC or something could get triggered. If the market falls by another 250 points, then some of those stocks which were triggered, say 5 stocks which were triggered, maybe 1 or 2 will hit stops, and another set of 5 will get bought here at these values. And this process will continue right about till the point where I'm marking 25,350 or something for me, at which point I would be completely invested in terms of my positions. All of my positions for that particular expiry, November expiry, would get created. And the reason is this, that because obviously I'm seeing a bearish confirmation and I'm seeing a double top holding. So I'm just I don't want to be the first person to say, okay, the double bottom has formed. I want to, if it forms, then yes, obviously, there will be some wicks below this. Some stocks will be just maybe 0.3, 0.4% correction. They will start. So there will be minor position buying if this indeed retains as a double bottom, but real money for me would be made if there is a slight temporary break of the double bottom and the market resumes back immediately after that. If that is to happen, that situation becomes favorable for me. What does not become very favorable for me is that the market, after forming the double bottom, so which means that, let's just say this is a range here of 26,100 to 25,700, which obviously gives it a target of 25,300, which is the previous gap support, which is the reason why we are looking at this. If the market does not respect that target, I mean, I'm expecting that after the target, the market will like sort of consolidate a little bit here, and then eventually move back up. There are still several trade sessions for the month and for the calendar year. Then maybe perhaps move back here. At this point, if it does this, then obviously it will be a bullish pattern on the daily time frame over a bullish structure, which makes it very interesting for us to buy. So I'm obviously trying to preempt it a few moves earlier. One doesn't have to always do it. One could just obviously follow a system, but I'm just sharing, I'm just thinking out loud that this is how I'm seeing these are the set of actions that I see myself do. Obviously, what does not work in my favor is if this happens, obviously people like me will buy, market will take a temporary support, and then if this happens, now that will be like very, not fun. Can it happen? Of course it can happen. Like obviously it can happen, and still the market will retain a decent structure despite it happening. But short-term traders will have to pay because the market would have created a new low after your entry, and obviously at a later date we will once again try to attempt. If suppose, say for example, it comes all the way till this level, we will again try to do the same thing. We'll try to buy right around here, thinking that this obviously is not what I have in mind, but something like this, and followed up with another break. So maybe what I'm hoping for will happen around these levels might happen lower, but that's the price action that is needed is this. This will make it, regardless of the level of where it happens, this will obviously be bullish price action. The deeper it happens, the slower the up move, the tougher the trading will be. But this is the price action that seems favorable for longs. And since my assessment from longer time frames is coming out to be on the long side, consequently, I'm hoping that this will sort of play out. And now, obviously, once so just to summarize it, let's just, because there is a bearish engulf, a bearish counter attack, and a bearish red candle, does not mean you have to be short. Why? Because we are seeing bullish structures on weekly, monthly, etc. But when we do see a bearish confirmation on the daily time frame, it means that the uptrend could be stalled for some time. And if the uptrend is stalled for some time, then the market could consolidate. The consolidation could happen in terms of price, that is, it could be a deep consolidation very quickly, or it could be in terms of time, that the market actually just moves 250 or 300 points lower, but it takes 7 trade sessions or 5 trade sessions or 10 trade sessions to get there and stay there. So the consolidation could be of two types. Now the thing is that if you have a bullish bias leading from anyway, my bullish bias comes because of my subjective assessment on weekly charts. If you are carrying a bullish bias at any point, you are going to buy into a consolidation only. And the occurrence of these bearish candles with the potential break of this pattern gives me the kind of short-term consolidation that is needed in order to build up a large position. So like if the market stays there for 6, 7, 8 days, then each day some positions are getting built up, and because the longer the base is created, the stronger the base gets. There are all these theories, so the idea is to work on them. And we'll use this and just move on to the hourly charts to see what's happening on the hourly charts. So in the hourly charts, it's looking like a perfect range double bottom, as we expect to see from the daily. So this is the double top, point A. I mean, it's just for ease of visual, you can write point A here, and similarly this point here will become like, say, B. So these A and B obviously are your double tops, and the same A and B we can see on the downside, which is your double bottom. So this is obviously a range, though we can see that as a day trader, you're seeing the preceding move of the range is bullish. So logically you would expect the double bottom to hold, but this is an hourly chart. If the market gaps lower, let's say on Monday, then we already planning, you can see the planning is coming for that purpose. So that is the reason why we analyze the charts on daily, weekly, because even though we want to trade on the hourly, the market could gap at any point, and our assessment needs to factor that what will happen if the market is 25,500, what will happen if it's at 25,100, and so on. Where are we going to react? What trades will trigger? These things are what we basically plan for. We obviously hope that the market, as investors in the market, as people who are committed to the market, we would generally want the market to rally up. But that's not always going to happen, and so that we can survive, we do this work in order to plan our exits, our stops, position sizing, and things of that sort. So the idea of Nifty assessment is obviously just to share what we are seeing on a certain time frame, and the thoughts that get generated when we see certain patterns build up. Real trading happens when you are with your when you're on your own, when you're planning your trades, when you are documenting your thought process. And when you do this several times, you inevitably create a framework of articulating your own thoughts and placing them. And obviously this video is just my articulation of the thoughts as they happen. So I'm sort of thinking out loud as I'm seeing the pattern form. So in that, I hope that this video has been of some use to you in your own understanding of the market, your own understanding of technical analysis, and also more importantly, seeing that nowhere in the video, or not just this one, maybe the hundreds of videos that is created, nowhere do we actually go about predicting the future. There is a pattern target of 30,000 ES that is there on the weekly, and there is a bearish M pattern could be forming on the hourly. Both the cases are true, or a double bottom now. But if there is a gap down on Monday, we are long, so we are only thinking about a gap down. If it's a gap up, I mean, there's nothing to think about it. We might have one lot, some people could have 10 lots, so we just simply going to sit and watch the market move up. But if it is gapping down, then that's where all our planning is happening, where we are going to buy, how much we are going to buy, what all stocks we are going to buy, which ones could get impacted. And therefore this is the part of the process that makes trading so exciting. So I understand that many people like me who try to educate because they have spent so many years, maybe decades, into the market, and this is all that they know, and this is one of the only reasons why they come out in front of people. When they're trying to educate people, one of the key things that the communication is centered around is that it is easy. All you have to do is this. So trading is just about as easy as thinking is. So thinking is also very easy, but we all know there are levels to how one thinks. And the analogy that I've given is that it's very is trading is much like chess. It's very easy to pick up a knight and put it on, say, c3 or f3 or whatever, or pick up a pawn and put it on e4 or d4, whatever, nice central squares. But it is very difficult to play so many good moves continuously. I would say even to play 20, 30 top quality moves based on what the position has to offer. It is very, very difficult to do, and without a framework, without spatial pattern techniques, without developing that skill set of pattern recognition, of eidetic or photographic, just seeing a picture and making a plan, without developing that skill set, and trading becomes infinitely more tough, because the process of taking a decision becomes much tougher. And you can assess when alone Nifty chart gives us so much information. So then when we do this work for hundreds of other stocks, the amount of information that traders are generally carrying, and the planning is quite vast. And therefore having a system, having a structure, having a smoother way of thinking, even if it is not the best way of thinking, but just it being easier and smoother way, logical way of thinking, is a necessity in this particular industry, which is the message that, of course, I want to share. Alongside, how do we trade bearish counterattacks? How do we look at double bottoms on hourly? How are we seeing saucer patterns on weekly? Alongside all these other very, very interesting things. So I hope you found the video useful in some way. And if that's the case, do share your views in the comment section and any questions that you might have. With that, I wish you all the best. Take care.